Hey everybody, my name is Justin. Today I want to do a video on Pinduoduo, ticker symbol PDD. This is a Chinese e-commerce, I'll say giant, and not only giant, but I think it's going to overtake JD.com here in the next few years. And if you've been following my channel at all, I am very bullish on the Chinese e-commerce market in general. In fact, Alibaba is my #1 position in my portfolio, representing 25% of my entire portfolio. And part of my due diligence whenever I'm looking into a company, I want to know more, understand the industry and understand better their competitors. And when I first started buying Alibaba back in the beginning of March, I looked at JD.com, I looked at Pinduoduo. In fact, I recently did a stock analysis on JD.com, so definitely go check that out if you have time. But when I looked at Pinduoduo back in March, I honestly just turned my back to it and said, this is not even a company worth looking into. I looked at the income statement and it's bad. We'll see here in a little bit. It's just bad. They have negative earnings. They've never actually had a positive earnings at all since they've been in business since 2015. They've been public for the last, I think it's been 3 or 4 years, but they never had a profit. So for me, I was like, it's not even worth looking into. Alibaba, JD.com are the big ones in that space, and that's the way it's going to be. But I got to tell you, after digging into Pinduoduo, boy, I am so impressed. I am very heavily looking into buying this company, even with Alibaba representing 25% of my portfolio. So in this video, I want to talk a little bit about the business overview of Pinduoduo, and we're going to really dig into the financials. And the reason why I do that, I'm an accountant. That's what I do for my day job, and that's how I analyze companies. That's how I look at companies. So we're going to go through 7 different metrics that I look at with every company. We're also going to do a valuation. I'm going to give you guys a valuation based on a discounted free cash flow method that I came up with. So hopefully you get some value out of this video. If you do, smash that thumbs up button. Really helps out the channel. I really appreciate it. If you like this content, I encourage you to subscribe to my channel, hit that bell notification. If you think others might enjoy this video, share this video. So let's just jump right into this. All right, so first off, Pinduoduo is an e-commerce business in China. They've been growing impressively over the last few years. So if we look at just 2 years ago, they represented about 4 to 5% of total Chinese e-commerce. And then in 2020, they represented almost 15%. So they've grown 3x. And keep in mind that JD.com and Alibaba are big in that space too. I mean, Alibaba was around, I think, 83% of the Chinese e-commerce 4 years ago. Now they represent between 50, 55%, somewhere around there. JD.com is also eating into that e-commerce business as well. But out of the 3, Pinduoduo is growing the fastest. They're about $136 billion market cap, somewhere around there right now. This is a very interesting company because I thought it was similar to JD.com. So, you know, we have JD.com, which is purely e-commerce, purely kind of I guess the best I could describe them is an Amazon type company where, you know, people can just go on their platform, buy, they can get delivery within, you know, a couple days, whatever it is. They have over 1,800 different facilities and distribution centers across China between what JD.com owns and also the third party. But, you know, JD.com doesn't have that impressive of profit margins. You're talking, you know, 5-6% roughly. So very, very tight margins, very similar to Amazon. Alibaba is just a beast of a company, I guess you could say. They have multiple subsidiaries. They obviously have their Alibaba.com e-commerce that a lot of people buy from, not just from China. So JD.com is more just China-based, so is Pinduoduo. Alibaba sells internationally. They have almost 1 billion users or consumers worldwide. Not only that, but Alibaba is also in the cloud play business. I think they're the 3rd largest cloud company in the world, and they're projected over the next 3 to 5 years to be the largest in the world above Amazon. So very diverse business overall. Pinduoduo I can't even really explain, or I can't really compare against another specific company because I haven't found one like it. They're kind of like a Costco because they buy in bulk so they can actually sell stuff at a cheaper rate to their consumers, but they're also like a social media and gaming platform as well too. So interestingly enough, I mean, you hear about Amazon, you hear about Alibaba having, tons of active users, right? Pinduoduo has the most active users out of anybody. They have, I think it's over around 850 million active users on their platform every single month. And the reason they can do that is they get people to come onto their platform to play games, to socialize, interact with others. So very unique, and it shows in their G&A expenses. They have a lot of research and development. And we'll get to their financials here in a second. But there's a lot of R&D built into this company because they're trying to build out their infrastructure, their gaming platform, their social platform within. They have 1,900 engineers dedicated just to build out their platform. So very, very unique business model that Pinduoduo has come up with. So that's kind of what they do. Let's jump into some financial metrics right now, and then we'll get into a valuation that I come up with. So let's take a look here. All right, so these are my 7 key metrics that I use when I'm looking at a company. If you look at my other stock analysis videos, I always talk about these, but I figured I'd probably write them out. So it's just easier for the viewer, and we'll just go through each one of these, and then we'll mark a yes or no whether they conform to these key metrics or not. So the first one I look at is sales growth over the last 5 years. I want to see at least a 10% growth per year over the last 5 years. Earnings growth, the same thing. Last 5 years, I want to see a 10% growth per year. Cash flow, same thing, 10% per year. Working capital, I want to make sure this is positive. Working capital is current assets minus current liabilities. If it's negative, it could be a red flag that the liabilities are higher, and it's more to kind of dig into. ROIC, so that is return on invested capital. That's basically net income over capital. Kind of gives us an idea how effective management is taking capital, whether that's shareholder equity, whether it's financing, taking that and then reinvesting in a company and creating net income. So 10% per year over the last 5 years. Long-term debt. So I want to make sure that this company can pay off their long-term debt within 3 years based on their free cash flow. And then lastly, I want to look at outstanding shares. Are the shares going down? Are they staying the same? Are they going up? Preferably, I want to see them going down in general, but we'll take a look at that as well. So let's take a look at the first one here, and that is sales growth. All right, so keep in mind this company has not been around for very long, 6 years in total, but they've only been public for about 3 to 4 years. So only about 3 years worth of financial information to look at. So just keep a look at, or just keep that in the back of your mind. All right, so sales growth, 23% growth per year over the last 3 years for sales growth. So that is a definite yes. The next thing we want to look at is earnings growth. Are they growing 10% per year? Yes, they're growing 138% per year over the last 3 years. And then we want to take a look at free cash flow growth. Are they growing at least 10% per year? Yes, they're growing 42% per year. So all 3 of those are a yes. So let's go back here. So that's a yes, that's a yes, that's a yes. All right, so now let's take a look at working capital. And working capital, we will find that on the balance sheet. Let's just jump over to Yahoo Finance. Keep in mind with Yahoo Finance, if you're looking at a foreign company, a lot of times they will be using the currency in that foreign country. So it's not in US dollars that we're looking here. I think it's in Chinese yuan, I believe. So just keep in the back of your mind if you're looking at numbers. All right, so what's nice about Yahoo Finance, they just break it out for us. Here's working capital right here. So it's a positive 65 billion Chinese yuan, but it is positive. So that is a X as well for yes. All right, so ROIC, long-term debt, and then outstanding shares. So let's look at those 3 right now. And we'll go back here and we'll take a look at ROIC. So ROIC, they have actually negative 29% over the last 3 years. So that is not good. If we take a look at per year, let's see. So it is getting better. So they were negative 54% in 2018, then negative 23, negative 9, negative 11, negative 4, negative 2. So it is getting better. But that definitely is a no on that one. So now let's go take a look at long-term debt. And they don't, and this is a no on that too. So actually it's going to take them more than 10 years to pay off their debt based on free cash flow. But one thing to note is, let's take a look at my Charles Schwab right here. If we look at cash and cash equivalents here, talking about $3 billion, cash and short-term investments total is $13 billion. So $13 billion in total. If we look at long-term debt, their long-term debt's $2 billion. So, even though, so it's interesting enough that Phil Towns' rule on Toolbox is saying it's going to take him over 10 years to pay that off. We haven't looked at the free cash flow because that's one thing that really stood out to me to understand what's happening with this company right now. So interesting enough, I would actually say they're in pretty good shape. So I would actually say yes, that one's okay. Let's take a look at outstanding shares. And outstanding shares actually have been going up. So they've gone from 638 million shares to 1.2 billion shares. So that's a no on that one. So let's go back to that summary here. So ROIC is a no. Long-term debt, I'm going to say yes, because of the $13 billion of cash on hand versus $2 billion of long-term debt. Outstanding shares, I'm going to say is a no because that's actually going up, going in the wrong direction. So something I really want to point out to you guys, looking at the financial statements right now, and it'll just probably be easier if we look at Yahoo Finance. All right, so if we look at the income statement, this is one thing that I looked back in March and I was like, no, I'm not touching this company. So total revenue, again, this is Chinese yuan. Keep that back in your mind. 75 billion for the revenue there, and then here's net loss. So they had 6 billion roughly, and then 2020, 7 billion loss. 7 billion loss in 2019, 10 billion loss in 2018, and so on. So they haven't had a profit at all. And I'm like, oh, that does not look good. But check the cash flow out, and let's look at the free cash flow specifically. Positive 25 billion for that. That's weird, right? Because just to kind of back up, so net income is basically telling us all the revenue and expenses that occurred in the same month to get to net income or net loss. What the cash flow statement does is basically take the net income or net loss in Pinduoduo's case, and it removes all the non-cash adjustments. So I had to dig into this company and figure out what was going on. If we look at the operating cash flow of this company, we'll kind of have a better picture of what's happening. So you can see here the net income for 2020 was a negative 7 billion. But if you take a look at change in working capital, so working capital again is change in accounts receivable, accounts payable, it's current assets, current liabilities, things like that. So this is what really stood out to me. Look at this. So change in payable. Look at 25 billion right there. So I was like, okay, something's weird here. And I gotta say, I'm always skeptical with Chinese companies, right? Because there's been companies in the past like Luckin Coffee where it's really burned their shareholders. So it's really important to really question numbers, in my personal opinion, about stuff that comes out of China just in general. And so my kind of sent a red flag. Something doesn't seem right. But I did dig into this company, and so this is how this company operates. And this is why they have free cash flow, but they have a net loss. So they are actually generating cash up front, and then they're paying their vendors later on. So how they've worked out their business is they actually collect money up front from their consumers, and then they're actually paying their vendors later on. So they're collecting cash up front, and then later periods actually paying for the product. And so that's what's creating this huge like tailwind of not profit but free cash flow for this company. So they're swimming in cash right now. We saw that $13 billion. It's because of their business model. So there's pros and cons with this, and we'll get to my valuation here in a second. But so the pro for this is they're collecting money up front. They're swimming in cash right now. We take a look at their income statement real quick, and we look at their R&D expenses. It's pretty big. So research and development right here, you're talking 7 billion. Again, this is Chinese yuan out of the 75 billion of revenue. That's a pretty good chunk. Operating expense alone, you're talking 56 billion. 7 of that is research and development. And again, they're building their platform. They're creating a gaming experience, a social media experience for their people that are coming on, their consumers buying their product. And there's positive and negatives to Pinduoduo's business model. They're getting cash up front, paying for their vendors later on. If for some reason their growth slows down, I think that's what the key is. If their growth really slows down, they have negative growth, all of a sudden that's going to reverse, and all of a sudden they're going to be negative cash flow, and they're going to be in trouble. I don't see that happening. I think they're going to continue to grow. They have the most active users that are out there, more than Alibaba, more than JD.com. But a piece of that too is, from a consumer standpoint, or I'll just say users, for the per user basis, their per purchase is actually lower than Alibaba and JD.com. There are people that just go on there and they're just playing the games. They're interacting with other people on the social media platform that they have. So they're not always buying, but I think it's a fantastic business model because it's actually pushing their product in their face. So I think over time they're going to see, maybe not on a user basis, but overall they're good. I think they're going to overtake JD.com. So now let's get to my valuation on Pinduoduo, and I'm going to do a discounted free cash flow model for you guys. And if you watch my other stock analysis, I typically do 4 different valuations. I do a margin of safety analysis, I do a 10 cap valuation, a discounted free cash flow method, and then also a free cash flow to enterprise or market cap value. Since Pinduoduo does not have earnings, I'm going to do a discounted free cash flow model because they have free cash flow. So their share price right now is $108. Shares outstanding about 1.2 billion. Free cash flow, this is in US dollars. I converted it for us. It's about 4.3 billion roughly over the last 12 months. Now net debt number. So net debt, typically you can just go to Yahoo Finance and pull it. I couldn't do that on this one. I had to calculate it myself. So it's basically current liabilities plus long-term liabilities, or so just think of all liabilities minus current assets. So this is really good. If it's negative, that means they have more current assets than total liability. So fantastic, which that working capital number kind of comes back into play there as well too. Now, market cap 136 billion. All right, so growth. So this is interesting. So they had 40% growth for free cash flow over the last 3 years that we saw, and that's per year. I am being super conservative. When I'm looking at any kind of Chinese companies, I got to be conservative here. There's more risk. It's a very fierce environment between JD.com, Alibaba, Pinduoduo. And so even though they've been growing 40%, I'm going to say 25% over the next 3 years. I'm going to say 20% 4 to 6 years out, 18% 7 to 10 years out. This is pretty conservative, again, like I was saying. All right, so now let's get to my valuation. So based on that, I'm coming with an intrinsic share price of $166 for this company. It's trading at 108, so 52% margin of safety. Now, I am using a discount rate of 15%. That's what I want per year. For my returns, I'm using an exit multiple of 20. So basically that's what I think, almost think of it like a PE ratio, what I think it's going to be worth out in the future. I do think Pinduoduo is going to be profitable here in the next year or 2 years, and my personal opinion based on the growth that I'm seeing. And I got to tell you, I'm really liking this company a lot. I'm digging more and more into it. I usually don't buy into companies that have a net loss, let alone Chinese companies. But I got to say, with this big pullback that we've seen in the Chinese companies, Love Alibaba. It's my number one position in my portfolio. But as far as e-commerce goes, I'm going to have to put Pinduoduo second on my list, and then JD.com. But I don't think there's going to be, you know, I don't think you can go wrong with any of those three companies right now. They are selling at such a cheap price as it is. Now, you may say, look at this valuation and say, you know what, your growth is way too low, Justin, and they're going to continue growing 40%. You know, maybe they'll drop a little bit after that, 30%, and then they'll probably be around 25%. If I do that, I think the intrinsic value is more at 341. So again, it's always about the inputs that you use for your valuation methods. Bad inputs, bad valuation, good inputs, good valuation there. So again, I'm just being conservative. I'm saying $166, intrinsic market cap of $207 billion versus 135 right now. So I really like Pinduoduo. I didn't even talk about the profit margins for this company, but they are better than Alibaba and better than JD.com. So yeah, interesting, guys. I really like this company a lot. I love to hear from you guys. What do you think about Pinduoduo? What do you think about JD.com? What do you think about Alibaba? Who is going to win this Chinese e-commerce race? What do you think about this big pullback we've seen in the market lately? Love to hear from you guys. Thank you so much for watching. If you haven't hit that like button, please do so on the way out. I'll catch you guys on the other side. Take care and God bless.